Good morning, everyone. Thank you for joining us today. My name is Andrew Paolillo. I'm the Director of Member Strategies and Solutions here at the bank. With me, as always, here is John Kornacki, Financial Strategist. And thank you for joining us for our balance sheet, strategy, and markets update. So as we have done in previous quarters, if you're familiar, we'll take a crack at this in three different ways. We'll talk a little bit about what's happening in the economy and in the yield curve and various relevant instruments. We'll also take a look at what's happening on the call reports for our banks and credit unions here in New England as of the third quarter. And then lastly, we'll look at some strategies on both sides of the balance sheet, some levers that can be pulled to help manage a risk and return. So before we jump right into the markets and the economy, a little lighthearted start. I saw this recent article in the Wall Street Journal breathlessly saying that, with the cryptocurrency craze that is ongoing these days, they discovered that if they put these physical locations where people could come in and trade the cryptocurrency and talk to someone who could help guide them, and they acted like this was the greatest thing since sliced bread. But as everyone here is very familiar, it kind of sounds like a bank branch. So let's not give too much credit for innovation to the new wave of the financial world right now. So we figured it out pretty well. When we think about depositories. So with that, I'm going to hand it over to John, and he's going to jump in to talk about the markets and the economy.
Thanks, Andrew. Good morning, everyone. So just to get started here, we're going to go through markets and the economy update. We're going to go through what's happening in the yield curve. We're going to revisit what happened during the last hike and taper cycle, talk about mortgages, and go through some other economic trends that we're paying attention to. So starting with short-term rates, as you look across the table, there's only one rate that jumps out here, and that's the 12-month Treasury. Everything else kind of kept status quo over the last quarter, and we're going to discuss this more in the next slide. But the big driver here is the market is starting to price in Fed policy moves. So let's take a look at the dot plot for a minute, as well as market expectations for rate hikes. You can see that from the September meeting, half the FOMC participants are expecting at least one hike in 2022, and that was an increase from the prior meeting in June. And then as far as market expectations go, when you look at how the market is pricing in hikes, you see that it's now pulling forward rate hikes quite a bit. When we looked at the data recently, if you actually go back to the mid-September, the implied odds of no hikes over the next 12 months was 75%, and currently it's 10%. So from September to today, we went from 75% to 10%, and that move was so fast and furious that expectations moved right past one hike in 2022, and now the market is actually implying two hikes. And the Fed has been very straightforward and transparent with their plan on conducting the tapering first and then hikes. So when you look at the market's pricing of hikes and compare that to what the Fed is telling us, you see that the market thinks the Fed may have some pressure in the next year. The other thing to note is the market is only pricing in the terminal rate of 1.5%. Versus the 2.5% to 3% that the Fed is seeing as shown by the dot plot. And so that means, when the Fed hiking process begins, the market thinks that the Fed will have to stop raising rates well before they reach that 2.5% to 3% range as indicated by the dot plot. And we're going to discuss this more in section 3. Historically, the market gets ahead of the Fed in pricing, in timing, and the magnitude of hikes. So that creates opportunity when managing interest rate risk. So while on the topic of Fed policy, we can take a look back at what happened during the last taper. Intuitively, you may think that with a big buyer going away from purchasing assets, that would cause rates to go up. But that's not exactly true, and it's not what happened the last time. So if we look back in 2013, once the taper tantrum ended, but before the tapering started, rates kept rising. But once the tapering started, things didn't follow what a lot of people would have expected. You can see that in this chart here. On the top left, that's the 3-year Treasury, and that tenor kept rising. But as we know, the 3-year is more sensitive to overnight rates. And then going across to the 5-year, that tenor moved sideways during the taper period. And then lastly, the 10-year during the taper went down quite a bit. So with Fed backing away from bond purchases, it gave investors more opportunity to move up in quality and still earn yield. And one other thing to note this time around, which is different than last time, there's a lot more cash in the system today. And as we all know, depositories love treasuries. So if rates do start to rise, you have to wonder if that gets dampened by more investors coming in and taking those down. So moving on to intermediate rates, this chart is looking at the change in short-term rates starting in July out to now. When the door started to crack open for the possibility for tapering with COVID progress as well as economic recovery, we saw rates begin to rise, and not just the long end like we saw in February through April of this year, but the 2-year and 3-year tenors as well. And that's how rate hikes are coming. And since mid-year, the move up in the 10-year has paled versus the 2- and 3-year, even with all the inflation discussion that we're going to talk about in a little bit. These moves of 34 basis for the 5-year, 38 basis points for the 3-year, and 28 and 27 basis points for the 2-year create asset deployment opportunities, which we're going to get into more in the third section of the webinar. So moving on to mortgage rates and spreads, if there's one common thread we've heard from members, it's that retaining fixed rate mortgages is becoming more prevalent. And as you can see in this chart, in the last 18 months, mortgage rates haven't moved much. They've been staying in the 275 to low 3 range. But if you look at the mix of yield, that has changed considerably. And you can see in mid-2020, the yield curve was low, but spreads were much wider, with spreads well over 250 basis points. Then if you fast forward to today, the yield curve is steeper, but spreads are much tighter at 150 to 175 range. So you're getting more from higher treasury rates, but you're now seeing narrower spreads. And this has strategy implications, which we're going to come back to a little bit later as well. So looking at MBS spreads now, this is another byproduct of QE. Excess liquidity and higher demand for MBS from banks and specifically the mega banks has kept MBS spreads tight. And then add to that, as the yield curve steepened, prepayments slow, as fewer mortgages have the ability to refinance, so spreads naturally tighten as prepayments slow. And this the challenge here is that spreads started historically narrow and have kept tightening just to really head-shaking levels at this point. If you look at the 15-year MBS, as shown by the green line, which is a natural asset for depositories, now you have spreads inside of 20 basis points versus treasuries. So when you think about everything you should be compensated for when investing in MBS versus treasuries, there's not a whole lot there. You're barely getting paid for prepayment risk, liquidity risk, and spread risk. So similar story with credit here as well. We hear about some pretty wild pricing from members on CRE and multifamily deals, but Here we're going to take a look at corporate bonds because there's a lot of good data to work with. The chart you're looking at here is showing Fed funds upper limit on the x-axis and the BBB corporate bond spreads on the y-axis. And what you can see here is also the legend is showing the different colors represent the different taper periods that we saw during the last taper cycle, as well as today, as shown by the light blue area. So if we look back, last time in 2012 and 2013, spreads tightened as the Fed hiked rates, and that makes sense. You had an improving economy, and with that, credit does well. But now, like we talked about with MBS, we're starting at historically tight levels. You can see that by looking at the light blue line, as I mentioned, on the bottom left of this chart. So it's hard to go any tighter than where we're at today, and it doesn't provide you much room for error when you're investing. So this certainly poses challenges to depositories when competing in these markets. So moving on to the topic that is all over the headlines, and we'd be remiss to do this presentation and not mention inflation. Transitory, not transitory, supply chains, commodities. These are all things that that we should be paying attention to. But as pragmatists, we see that the long end of the bond market doesn't seem to doubt the Fed's ability to fight inflation if need be. As CPI shot up to 6.24%, the 30-year Treasuries barely blinked, and even going down 50 basis points. I do have to actually point out too, since we did pull the data and we finalized the deck, rates did come back up 20 basis points. So I'm gonna blame Andrew on that one, because we thought we were done here, but we did see a little bit of movement after that. But I will say also, let's keep that in perspective. It barely broke 2%, and financial institutions, they purchase rate instruments on balance sheet, not economic readings. So the yield curve tells you more than the prices and goods and services do. And one could argue that if inflation is truly sticky, it may be credit negative if input costs go up sharply for households and businesses, which could drive a flight to quality bid for treasuries. So lastly in this section, we're going to finish up with labor. I'm sure most of you have heard and seen businesses having a tough time hiring people right now. The labor market is very tight, and companies are doing everything they can to attract new workers as well as retain current ones. And you see that with wage data. Paying people more money is one way to attract workers, and the data shows that the job switchers right now are taking advantage of that. A lot of these wage jumps are not coming from our industry, but it has been discussed a lot more in bank earning calls as well as discussions with members. People do worry about retaining employees as well as growing their teams, and you're seeing those increased budgets for next year for many institutions. So with that, I'm going to turn it over to Andrew to go through some call report trends.
Thank you, John. And I wear proudly my jinx of the 30-year Treasury. I only wish I had that much influence over one of the most important interest rates in the world. So, we'll take a look all across the balance sheet, both sides, look at some key metrics, and share some analysis of things that stood out to us about what is happening in the industry, and most specifically happening for banks and credit unions here in New England. So the first thing we'll look at is cash levels, and prior to 2020, that's a pretty boring thing to talk about. But given the expansion of just pure cash on balance sheets, it is important to look at. And in the second quarter, we saw some trend of normalization in cash levels, right? Credit unions, the median credit union brought cash down by 3% from 12 to 9. Banks had a downtick as well. But in the last quarter, we saw a little bit of a change where banks were up slightly in terms of the amount of cash, and credit unions were mostly flat. So, why is that happening? So if we flip to the second slide, before we get into the asset deployment history, it really starts with deposits. So as we all know, deposits have come in fast and furious over the last 18 months. So it wasn't just the 2020 surge. That growth continues to be running at very high levels. So what we're looking at here is all of our depository members ranked in ascending size with on the x-axis, and the y-axis is the quarter-over-quarter change in non-maturity deposits. So we can see a roughly 2.7% median. That equates to an annualized rate of double digits, which is impressive in its own right. And that much more impressive when you're considering, like we said before, it's already starting from the higher base of having elevated throughout 2020. So, when you squint and you look at, we broke out banks and credit unions here, you see the blue circles up and to the right here with above average growth. Those are our larger banks. And you see more, the green X's, those are smaller asset size credit unions with growth only in that 1 to 2% range. So there's the contributor to why banks saw the uptick in cash quarter over quarter. It was the deposits continuing to come in. And interestingly, this is the complete opposite of what we saw in the first quarter of this year, where it was the smaller credit unions who had the above average growth. And that was attributable to the consumer-centric stimulus that we saw rolled out earlier this year. So there's deposits contributing to cash. Let's look at what's happening on the loan side. So, here's our chance to use all the crayons in the Crayola box and put the fancy charts out there. So I'll just walk through, what we have here is, looking at overall loan growth. We know to get a true reading, we need to strip out the impact of PPP. And what we've seen the last 2 quarters, that growth has been around slightly more than 1.5%. So 6% annualized rate roughly, which is pretty good on its own right. But again, remember, we're starting from that point of excess liquidity and excess deposits, as well as continued above average deposit growth. But in any event, the first step is loan growth coming back, and it is. As John mentioned before, 1 to 4 family retaining residential mortgages has been a common theme, and that's borne out by the numbers, not just the anecdotes. Upticks in the amount of resi mortgages staying on balance sheet, and when we parse through it geographically, we see that Maine and Greater Boston are leading the way. Looking at banks and credit unions individually at some key loan sectors, CRE growth continues to be slow and steady for banks. Positive numbers, but in that 1 to 2% range. Again, like the resi, Maine leading the way across our 6 states. For credit unions, auto loan growth, we've talked about the challenges here because of the supply chain issues, and also the shorter nature and the high cash flow nature means that the originations really need to get cranking for growth. And so after a couple quarters of negative auto loan growth, it is trending back in a positive direction, which it's certainly welcoming to see. And 3 for 3, it is once again led by our members up in Maine, seeing the above average growth. So moving to the next slide is another way that we look at loan growth. And what we're looking at is current balances here as September 30, 2021, and seeing for various loan categories if we have more loans today than we have in any of the previous quarters. So when you see some of these lines trending down, what that tells you is that we have more loans. We're doing a better job today than we did in any of those previous quarters. So we can see the dashed left line for on the left-hand side for banks, that's CRE. So that aligns with that slow and steady progress. We're able to add more commercial real estate loans to the balance sheet. Now this is binary; it's either higher or lower. So while CRE loans today may be higher than they were 4, 5, 6 quarters ago, it may not be to the magnitude that you would have hoped for, right? It's 1% higher than it was a year ago instead of the 10% budgeted growth that you had forecast. Looking at the credit union side, same trend. We see that dashed line, which is used autos, a core asset for many credit unions, that more and more credit unions today have lower balances there than they have over previous quarters. Interesting to note is on the top right-hand side, about 3/4 of credit unions have lower 1 to 4 family balances today than they have over the previous quarters. And that goes against the anecdotal, we're keeping more mortgages on the balance sheet story that we've heard. I think that's a function of 2 steps forward, 3 steps back. When you think about, you may be originating and retaining more mortgages, but the cash flow and the prepay activity has been so strong that it's actually overwhelmed in many cases a strategy of keeping more loans on the books. So when we think about, so we've talked a little bit about deposit flows and loan activity. So let's look at them together. So here we have very simply, who won in a head-to-head matchup, the amount of deposits that came in or the amount of earning assets they were able to deploy. So what we see in the last 2 quarters were pretty balanced, very close to 50-50 in terms of you either put more investments in loans to work, that's the green line, or the blue line is we had deposits come in more than we were able to put investments in loans to work. So that's what you would expect to see in a normalized business as usual environment. But the caveat is what you see on those 5 quarters to the left, that deposits activity outweighed the asset side pretty considerably. So there's almost this air pocket, you will, of all the excess liquidity that in order to get to a normalized balance sheet, we would have to see the asset side really move past that 50-50 split and really get to a more aggressive level. So switching to investment portfolio activity and trends. So one thing that we can look at is the amount of unrealized gains in the bond portfolio. And as would be intuitive, you would expect as rates fell in 2020 that it was pretty easy to have to be in the black. So that's evidenced by the predominance of the green bars. Those are the percentage of members, bank members, because that's what the call report data gives us, who had an unrealized gain on the bond portfolio. But then as rates began to rise in the first quarter of this year and over the last couple months, particularly the intermediate end, we saw some of that start to swing. And it was certainly supported by the fact that more and more of the composition of today's investment portfolio was from recent purchases, right? That growth that we saw because of all the deposits that came in 2020. More of today's composition was put on at low yield, so that as rates rose, they were a little bit underwater. And so, while it never feels good to see a negative sign when you're putting together an ALCO report and sharing, say, hey, we're the bond's worth less than what we paid for it. It's important to remember the fundamental construction of the depository balance sheet, where you probably want to be rooting for your bonds to go a little bit of underwater, right? Because chances are your durations are very modest. You have a good amount of cash flow coming off naturally, right, through mortgage-backed securities and things like that. You're not really taking credit risk. So the value is not in the mark-to-market fluctuations, but it's rather in your ability to redeploy those cash flows at higher rates. So, you may have things coming off at 1%, and you're able to deploy it back at 1.5%, 2%. So, that's the glass half full perspective on, what may be happening or have happened in the investment portfolio. So, as I mentioned, call report data is different from banks and credit unions. Credit unions actually provide an awful lot of detail on participation loan activity. So this is an interesting thing that we pulled. So this is looking at the last 4 years, through the first 3 quarters of the year. So it's an apples to apples comparison of the amount of participation loans that our credit unions have purchased, as well as the number of members who did that. So 18, 19, and to some extent 20, the activity was pretty similar, right? Same amount of credit unions buying the same amount of participation loans. But what we've seen in 2021 is that number has accelerated pretty considerably, right? So instead of the mid to high $400 million level cumulatively, it's moved into the mid 500 million. And also the number of members has gone up by about a dozen or so. So I think the takeaway here is that, with the excess liquidity, every rock is getting turned over in terms of how we can deploy liquidity and put some earning assets on the books. And certainly participation loans can be a unique way to get exposure to an asset class that maybe you don't have the in-house capabilities or wherewithal to originate yourself. And that's certainly borne out by, we can see 46% of credit unions were participating in commercial loan participations. So the next thing is a little bit of a blast from the past. As just like in the first section, John had looked at the what happened to the yield curve in periods of tapering. So what we did here is let's look at what were the deposit betas the last time the Fed started to hike rates. And as many of us know, the ability to lag deposit rates and the stickiness of deposits is a pretty big contributor to the interest rate risk profile of your institution. So what we saw last time is that deposit rates did not move higher for easily the first 100 basis points of move, but really only until Fed funds got to above 2% was there really some pressure to raise deposit rates. And so what we did here is we looked at the deposit beta, and we looked at the median, but also the more aggressive 75th percentile, as well as the folks who had the ability to lag even further down in that bottom quartile. So even the most aggressive folks who felt the need to really ratchet up the deposit rates really did not have much sensitivity to rising Fed hikes. So I would argue how at this time around, the similarities and the differences, the amount of excess liquidity right now, the steepness in the curve, the narrower spreads suggest that you're going to have more ability to lag on deposit pricing than even that you did 5 or 6 years ago, the last time Fed hikes really started ramping up. So that is going to I know we hear from a lot of folks who say, well, this cash, it's uncertain. We're asset sensitive, but we really don't know if we're really as asset sensitive as our models are telling us. Well, here's a little bit of support that you may actually have the ability to take some interest rate risk, and John will talk about this a little bit more in section 3. So let's talk a little bit about margin. As we mentioned before, the PPP program has been a big part of what's been happening for community institutions. And from our perspective, the PPP creates a little bit of noise when looking at just the pure levels of NIM. So when we strip out the impact of PPP income, we can see in the last few quarters, it's really taken about 7 or 8 basis points out of what we can consider, core NIM or actual NIM. And that has helped mitigate some of the impact from the elevated cash levels that we talked about at the beginning of this section. And the impact of holding that cash and getting paid 15 basis points from the Fed has brought NIM down by about 20 basis points or so. We've seen some improvements from the beginning of this year, but that is still a considerable level of drag on margins. And moving to the next slide, it's all the more important because when we think about what is working for us and what is working against us in terms of improving or preserving our margin, I'll go out on a limb here and say, chances are most every loan that is rolling off in any given month is probably getting replaced or has the potential to get replaced at a lower yield than what is available in the market, right? We talked about how 3% is where residential mortgages are right now, plus or minus. Both for banks and credit unions, the average yield was a little bit higher than 4%. So certainly, when we think about the competition for commercial loans or even the auto loan side, you'd be hard pressed really to get to that level. So asset yields, loan yields aren't really helping margin. Investment portfolio, with select opportunities, depending on your current mix, you may have some opportunities. Certainly from credit unions, where the median investment yield is a little bit lower, partially due to no tax exemption, which is helping elevate the bank bond yield there. Going from cash to investments, but also is certainly going to help. Investments, cash flow rolling off and getting replaced in investments is going to help incrementally as well. But really the big driver is going to be roll off of certificates of deposits. And that's what this very noisy chart here, scatter plot here is. It's showing NIM versus the percentage of certificates still left on many of our bank and credit union balance sheets. So when you think about absent no changes in rates or asset deployment opportunities, if you have a certificate rolling off at 1%, no matter what you do with it, whether you pay off cash or it goes into a money market at 10 basis points or you look at wholesale at 30 basis points, you're going to see some NIM relief. So very quickly, talking about credit, I'll reuse the analogy that I have used before in that, when COVID hit, we put the storm windows up and we prepared for the worst. The house didn't get any damage. And not only did the house not get any damage, it really didn't rain that much outside. After some very aggressive provisioning in 2020, slowly but surely, the trend has been changing. So here we're looking at members with negative provisions, no provisions, or positive provisions. And as we sit here this last quarter, over 50% of members had either no provisions or a negative provision release. So that is certainly a positive trend. And even with that reduction or lack of buildup in reserves, the coverage ratio with non-performing assets continues to be extraordinarily high. So that tells you that not only despite the numerator going down, reserves, the denominator is moving in a positive trend as well in terms of really the lack of non-performing assets out there. So the last thing I'll talk about here before we pass it back to John to talk about some specific strategies would be the valuation and the outlook for our public banks. And I think as I said before, it's a good proxy for the health of the industry, even if you're a mutual or a credit union. And bank stocks have done pretty well, and particularly in the last few months. And the two drivers there are, as we've talked about before, the prospect of higher intermediate and long, or not the prospect, the actual higher intermediate and long rates that we've seen, which is going to help improve the asset side of the equation, but also the prospect of higher rates, short-term rates on the horizon, which is supportive of the deposit franchises, right? All those non-maturity deposits and sticky money markets that came in over the last 18 months, begin to have more value if short-term rates move higher. So that is a positive driver for earnings and equity across the board. So I'll now pass it back to John, and he'll talk about some balance sheet strategies.
All right, thanks, Andrew. So starting off here, let's go back to what we talked about earlier, and there being more slope in the curve. Up until the second quarter of this year, rates were so low, it was easier to justify keeping cash on reserves at 10 basis points rather than extending. But in the last 2 months, things have changed. The 3- and 5-year treasuries have gone up by 50 basis points. Now you can get paid for moving out on the curve. And as we observe and hear directly, many of our members are more asset sensitive now, even adjusted for cash. So going from cash to bonds at 5 years is actually a risk reducing move on the balance sheet in a lot of cases for our members. And so where do we go? As mentioned earlier, 15-year MBS is a natural depository asset, but spreads have tightened considerably. And when we've observed a noticeable pickup in the number, we have observed a noticeable pickup in the number of members who have added treasuries in recent quarters, and that aligns with the graph shown here. This is something that we monitor, and it's showing, are you getting paid more for rate risk or for spread risk? When the graph skews up high like it is now, there's value in taking pure rate risk via treasuries. When it's low, like earlier this year, the incremental spread from the asset has appeal, and even mitigating some of the duration can make sense as well. So as we mentioned, many members have said, we're so liquid, we're holding production and not selling like we usually do or prefer to. There's some pretty good chunks of 2020 and 2021 mortgage rates that are below 3%. And at those times, bond yields were 1.5 to 175. Sorry, I think I skipped a slide here. There we go. At those times, bonds were at 1.5 to 175. But as spreads between loans and bonds have contracted, there's more yield available in bonds versus loans. So if you're going to take interest rate risk, there might be some more value to take it that way. All right, so here we are. So the question is, what can you do if you portfolioed more low coupon mortgages than you would have cared to in a normalized balance sheet world? And one idea would be to sell seasoned mortgages in a shelf transaction. So through MPF Traditional, the bank's secondary market outlet, we provide current pricing on seasoned loans up to 24 months. So if we take a loan in this example at 2.875, that's pricing just a hair above par right now. And so you could sell that longer asset that's yielding less than you prefer and provides little cash flow, and do that at a gain. And when you consider that by holding it for the past 18 months or so, you've earned the coupon. So by selling it now at par, when you look at it from a total return perspective, you're actually at levels that you would have seen, with those high gains back last year that many members experienced. So you can reach out to your relationship manager if you have any questions about this program and how we can help you with that. So as we discussed, there's value in extending assets. If your margins are under pressure, or you might need some growth on your balance sheet to counteract that, the question is how and where do you fund it? When looking at advances right now, there's a significant relative value in floating rate advances. So, and maybe you're thinking, that sounds a bit crazy with the likelihood that rates are going to rise in the near term. First, even when you look at the 1 and 3 month terms where hike odds are at near zero right now, there's anywhere from 4 to 8 basis points of savings versus the classic fixed advance. And you see that in our SOFR and DNA floater advances. And then at the 1 year mark, the differential is 16 basis points. So day one on SOFR plus 17 over the index is 22 basis points versus the 1 year classic at 38 basis points. But you have to keep in mind there's no free lunch. So there is a trade-off when you're looking at fixed versus floating, and hikes are coming at some point. So that leads me into the next slide here and how you can utilize floaters in working with Fed policy and on your balance sheet. So as we talked about earlier, oftentimes the market gets ahead of the Fed, and this is an example of where the floater will outperform. And if you think the pendulum kind of swung too far these past 2 months, so instead of 2 hikes implied for 2022, and the Fed actually goes slower and only hikes once in July. So for whatever it's worth, that's really not an out of the box thought. If you've seen a lot of strategists come out recently, there's quite a number of folks that have said that they think the Fed is actually not going to hike until 2023. So keep that in mind here. But anyways, when we're comparing the 1 year fixed, this is comparing the 1 year fixed versus the 1 year floating. So in the 1 hike scenario, even when SOFR floaters adjust higher, the differential early on was so stark that the total cost across the 12 months is still in your favor in taking down a floater. And the key thing with assets like this, with assets just like with liabilities, is it's the appeal of the spread, not just the yield. So just to finish up here, 2 other ideas to put on your radar that may or may not apply. If you have an existing advance on the books, check and see if there may be a restructure opportunity. You can lower cost of funds with no prepay fee and no incremental liquidity. And we've seen interest in a strategy that we call restructure and invest. So if you've been reluctant to make the leap from cash to, say, 5-year investments, a restructure can help mitigate some of the interest rate risk and boost yield. As an example, if you extend the liability by 2 years, that 5-year asset becomes a 3-year asset because you're mitigating some of that interest rate risk through extending your liability. And if you're able to reduce the advance rate by, say, 50 basis points, that's like adding 0.5% of asset yield. So please reach out to us and we can run the analysis for you and see if it makes sense at your institution. And then with a lot of questions around what the Fed will do in the coming months, volatility has moved higher, and higher volatility should benefit depositories through wider MBS spreads. But as we've talked about, QE has dampened that. So the other way to take advantage of volatility is with puttable advances. And we're not quite there at present, but shifts in the market could push some of these structures into having fixed rates of 10 to 20 basis points. And that's before accounting for the 8 basis point benefit of the activity stock dividend. Also, watch out in the coming months for our flipper advance to be reintroduced. This is a float to fixed structure. So as an example, you could see something where you pay SOFR flat, which is currently at 5 basis points for 1 year. And then if it's not put back, you could flip to a fixed rate of 125. So there could be opportunity to get some margin relief at a time when certainly everyone could use some relief. So with that, I'll turn it back over to Andrew to close this out.
Well, thank you, John, and thank you everybody for being with us today. Hopefully you found a little bit of this informative and helpful. And please feel free to reach out to us or to your relationship manager if there's anything that we can be of assistance with. We're happy to share any of these visuals or run any kind of customized analysis that you may find helpful. So with that, we'll wrap things up, and hope everyone has a great rest of the day. Thank you.